I'm just going to add a couple of comments from IFC's perspective. We invest globally in emerging markets about $20 billion a year, and last year about a quarter of that, so about $5 billion, was in Africa. That's up from about 100 million a decade ago. So in the course of the last 10 years, our investments in Africa have multiplied 40, 50-fold, okay? And that is driven not just by the fact that our strategy is to do more in Africa, because that's always been the case. That's been driven by the opportunity to do more. So what we focus on a lot of the time is the pipeline. What is the opportunity? We invest across all sectors, generally in private investments, both debt and equity. And one example alone, I think, kind of illustrates what's changed, and that's in infrastructure. So a few years ago, the amount of private investment in infrastructure, and we only invest in private projects, the amount of private investment in infrastructure was almost negligible. I mean, there were maybe one a year IPPs, for instance, independent power plant projects in the whole continent. Now, there are multiple opportunities to invest in private infrastructure projects. Last year, depending how you measure it, somewhere between $5 and $10 billion. Within 5 years, that'll be 20 to 30 billion. And what you need is the three parts of the tripod, effectively. You need the investor appetite, which I think we have. I mean, we've seen a lot more people, whether it's public or private, or large or small, or regionally focused or global, a lot more people focused on looking at the opportunity. And one example of that is just the attendance at this conference today. The second part of it is in a sense, the supply of bankable projects. And I think there a lot of credit is due to the regulatory improvements that we've seen across many African countries in terms of creating an environment in which private infrastructure can actually exist. And then tends to get forgotten in the debate between, well, is there too much capital looking at too few projects, or are there lots of projects that can't find capital? What's often lost in that debate is actually the person, the entrepreneur, the business, the sponsor who's actually putting the project together. Bringing together the engineering skills, the sort of the legal input, the financing, getting the regulatory approvals, and so on and so forth. And that is a scarce skill set, okay? So that's one of the reasons that we, as well as investing directly into projects, also invest in private equity firms in Africa, because they, amongst others, are the ones who are actually making things happen on the ground and being able to marry the capital with the actual underlying project. So I would say that that's a very important facet of sort of future growth. We're very encouraged by the improvements in all three of those dimensions in the last few years, and we forecast that will continue into the future. Before I throw it open for Q&A, I'm going to ask one general question, and I'm not expecting everybody to answer, so maybe a couple of answers here. And one of the themes that we've been asked to think about here is the co-investment opportunities, and particularly between international investors and local investors teaming up together to invest in a specific project or company. So question is, what are the recommendations you would have either for the investor in this situation or for the policymaker in terms of how one can encourage more of this sort of international plus local co-investment sort of happening? So does anyone want, we haven't rehearsed this, there may be no takers on this, but does anyone want to jump in and take a shot at that question? Nicholas, you were the first.
I'll try to give an example of, like, suppose you're a North American pension fund and you're going to an African nation to invest in a particular municipal waste management or water treatment. So it's an infrastructure project. And if you look at the public or the government, if it's a municipal water treatment project, the municipality, which is a form of government, is the co-owner, possibly, or the co-investor in that infrastructure asset. You have the local government at the national level who sets the rules, and if there is a legal problem 5, 10 years down the road, if you go to court with a lawyer from Seattle, for example, and if you sue the government, well, you have the government who's a co-investor at the local level. He's also the judge of last resort, and there's a different branch of government which controls the price of most utilities, be it toll roads, highways, airports, or municipal water treatment. So you also have a public entity which sets the price, because most infrastructure assets are price controlled or monopolies or duopolies. And so there is a risk that if you are a private sector pension fund, and if you're going to Africa, you are facing multi-layered levels of bureaucracy where the government is really everywhere. And if it's a 30-year concession, it's a very illiquid, very long-term, basically, asset class. You cannot just, if you're unhappy, you cannot just sell it and leave the country. So if I had one message to convey to African policymakers, be it at the federal or local or municipal level, is to walk the extra mile to reassure foreign investors and really show them in very concrete terms that the legal, regulatory environment is really investor friendly, not only at the level of, speeches, but on the ground, showing them that ownership will be protected, that if there is a problem down the road, courts, judges are truly independent. If you have that in place, I think a lot of capital will flow to Africa, because there's a lot of enthusiasm for Africa. The only, or the biggest hindrance is, I think, that multi-layered level of governmental, influence, where the private sector pension fund feels that, the scales of the balance are tipped against him. So if they can be reassured that they're really investing in a fair and square environment, I think a lot of money will flow to Africa, to infrastructure and to private equity.
Great. Any other takers on that?
Yeah,
Wale?
yeah, let me actually talk about a live one, which actually addresses part of Nick's concerns. And I think if you're a pension fund all the way, trying to invest directly in a project in Africa is tricky for all of the reasons you identified. So the key thing, frankly, is identifying the right partner on the ground and to make sure that the partner can get you through all the local regulations. So for example, the Union Bank deal that Bob Diamond talked about, we were kind of an investor in there. It was a co-investment by a private equity fund that had to raise $800 million. And they were coming up with about $80 million of it. But so what they do, reach out to institutional investors here in the US, some private equity shops that have knowledge in the financial services industry. The local partner, given the fact that they'd done this before, and helped really pave the way for all of the local challenges that could happen. And frankly, we have the regulator that approved all of the deal right here in front of us. And that was a success story, and frankly, and we're getting the benefit of it. But I think the key to it, though, for a pension fund is identifying the local partner, and rather than trying to do it on your own.
Okay, Wale, thank you very much. I know Elias has to leave, so I'm going to ask him to jump in on this very briefly, then a brief comment from Ashley. I know he's anxious to say something, and then prepare your questions so we can take a couple of questions before we wrap up here. But Elias.
Thanks. I'll comment as a host. And commenting as a host, I will say domestic capital first, and domestic resources should lead in a co-invested environment. I think it is about time that African resources are utilized in funding African projects. Earlier on in the discussions, there was a discussion about bringing capital from offshore. We have observed that there's a lot of pension funds, African pension funds, sitting in Europe, being managed by Europeans for African interests. And I think that needs to change. We need to repatriate the capital back onto the continent, get it managed by Africans, or even if it's non-Africans, they should be based in Africa, looking after African interests. Currently, there is a potential for a non-consistency in decision-making and interests of the continent. And the only way to align is making sure that the management of the resources is done within the continent. Thanks.
Okay. Elias,
Apologies,
thank you
I
very
had to
much.
run.
No problem at all, quite understandable. Ashley, over to you, and then we're going to bring in a couple of questions.
Yeah, thanks, Gavin. I would just give some very quick alternative perspective. As we sit here in New York, I think it's important for the various governments to be represented here in the States and to be able to engage US private and public investment more readily. A good example would be the Nigerian consulate here in New York, engaging with African Alliance and myself with regards to making some of their government delegation available to major US investors as and when they're through town. You don't have to travel to the continent to get an idea of what's going on or to be able to engage. And I would encourage governments to do that over here as regularly as possible. Yeah.
Great. Okay, thank you very much. Do we have any questions from the floor? We have one over here. I don't know if there are any microphones that maybe we can lend this gentleman. Yes, there's one coming. Whilst we're at it, any other questions? Yeah, so then another mic over here.
Hello. Yes.
Yes.
I've got a question for yourself. I just wanted to know, based on your understanding and experience investing in Africa in infrastructure, how successful has the PPP model been with regard to funding infrastructure projects in Africa? You know, private-public partnership model. Has it been successful? Are there concrete experiences where it has worked, let's say, with regard to road infrastructure building?
Okay, whilst I think about the answer to that, maybe we'll take another
Thanks.
question.
My name's Graham Sinclair, Cinco. The answer I'd like from each of the panelists and of course yourself as the host is investors in Africa. Do they prefer to go into and thinking of offshore investors, not what Elias is referencing, the local investors? Are you experiencing investors who say, take me to frontier markets or interesting sectors or promising themes, and Africa is a piece of that? Or are your investors, your clients, your widows and orphans explicitly saying, no, we must cover this particular geography and we must cover it in this particular way?
Okay, so any other questions, or is that okay? Okay, so final question over here.
Thank you very much. My issue is on infrastructure. Somebody mentioned that this is a sector where investment is likely to go from 5 to 10 billion currently to maybe twice or three times 25 billion over the next medium term. And that a challenge is actually getting projects developed. So if you're going to leave that to sponsors and the skills are limited there, what can be done to accelerate the project development skills? Can they be transferred? Can they be bought? Can they be nurtured? Or are they just haphazardly arising out of individual sponsors' initiative?
Great. Okay. So thank you for all the questions. So I'm happy to give a shot to the first one. Does anyone else want to take the first? Yes, please, Raphael. Go ahead. Do you want to answer the first one?
I was going to do the second.
The second one. Okay. Anyone want to answer the first one? If not, okay, I'll give it a shot. So PPPs. You know, there is a PPP industry in a sense. There's a whole vast volume of work that's been done in terms of public-private partnerships, sometimes described as, private capital for public services. And essentially, what it boils down to is how you allocate the risk. Okay, and there have been many situations in which, yes, public and private capital have jointly funded the same infrastructure project, but the allocation of risk between the two has not necessarily been, appropriate in either direction. I mean, there are plenty of examples of the government in question giving too much subsidy, and there are plenty of examples of, the government being unrealistic about how much subsidy is required for specific types of project. It's easy to generalize, by the way. Each sector has a slightly different experience in this. Our experience, having not only invested in a lot of PPPs, but we have a whole business in terms of giving advice to governments on how to structure PPPs. That's a whole, side of things where at any given moment we're probably advising on about 80 different PPPs around the world. Is that one of the lessons we found is simplicity. I mean, it is very easy if you try and define the risk 10 years out into the future and then allocate every single little morsel, that it's incredibly complicated engineering, legal, it's costly, takes a long time, there are lots of things that can go wrong. In the meantime, governments change and maybe have a different perspective. So one of the rules we've learned is that simplicity, and there are some examples now, for instance, in the power generation field with IPPs, where there is a template. And I think that the more that one can say, look, this has been tried somewhere else, it worked, let's try to replicate that rather than reinventing the wheel. By the way, everything I've said applies not just to Africa, but everywhere. Okay, none of this, both developed and developing world. And I think there are some countries that have had a lot of experience in this, others that have just done one or two. For instance, in North America, Canada has done a huge amount and the US has done very little. So every country has a slightly different experience or skill set in this field. But if there's one lesson, I would say keep it simple. Demonstration effect works. If something's actually done quite well, let's say a toll road, then replicate that, do another toll road in a similar fashion. It's easy to make generalizations, but it's always project by project, transaction by transaction. The solid regulatory framework that we heard from Nicholas and others will always help, of course, and that sort of, in a sense, goes without saying. So that was the first question. The second question, I think, had to do with this issue about, do investors think about Africa as a region or a country per se, or is it more a theme, which Africa may play a part of the theme? Does anyone want to take that? Raphael?
I just would comment, I'd say in the couple up to about 50 deals we did in the last 3 or 4 years, there'd be a piece that would possibly be assigned to Africa. In other words, it'd be global, and they'd have a percentage, 10, 15% South Africa, or 10% in Central America or something like that. Not that they would invest it, but they had the allocation to do that. Today, it's specifically, I'm talking about Africa. We're looking specifically at investing in Africa, not 50% Africa, 50% Asia. It's focused. So I hope that if that's your question, that's what's happening today, at least in U.S. funds.
Okay, Wale and then Ashley.
Yeah, let me share a different perspective, though. So our investors are generally U.S. endowments and foundations, and the way they arrive at Africa is by trying to invest in regions of the world that were growing really, really fast. So they went ahead and invested in the BRICS, obviously, and not to say that growth necessarily translates to return opportunity like Joseph mentioned, but at least in general, hopefully if you have an investment in a country or region of the world that's growing really fast, you have the wind behind you, and if you can find really good opportunities. So that's how they got to Africa. It's a function of the growth story, trying to capture the growth story. Having been through the BRICS already, now looking for the next destination that's growing really, really fast. So frankly, that also captures the theme approach of investing as well.
Yeah, 2-3 years ago when the larger BRIC markets started to underperform, let's call it, we had the Africa Rising story, obviously 6 or 7 years into its decade. And you saw larger emerging market managers looking for that growth and that diversification. Over the last couple of years, the frontier and African stock markets, from my perspective, have performed very well, right? Not this year, but the 2 prior years, they were up approximately 50% each year. And that in itself has brought interest in specific mandates to invest in sub-Saharan Africa and frontier. It has plateaued slightly. You've seen managers that launched 3 to 5 years ago that have performed well, raising capital, many of whom have now closed their doors to new investment. So we're now really waiting for the next wave to get their 3-year track record almost, and to see that new capital come in. It'll be interesting to see how it unfolds, as the larger emerging markets seem to be performing better now as well.
Okay, and then I think the last question had to do with infrastructure. A gentleman was asking, about, what can we do, what are we doing, and what can we do to help with these bottlenecks and, you know, the sponsors, can we rely on the sponsors? Do they need help or supervision in some way? Does anyone want to take that question? Or is it, I'll be the goalkeeper here and, or the sweeper, and try and take that one then. I think that one needs all of the above, okay? I mean, I mentioned in my remarks earlier that one of the reasons we invest in local private equity firms in Africa is precisely because they are making investment projects happen of one sort or another, okay? Not all of them are investing in infrastructure, but some of them are, including specific infrastructure funds. And, you know, building a pipeline in infrastructure in particular takes a long time. These projects have long gestation periods. They require focus, they require a skill set, and they require a kind of a long-term perspective from the very beginning. So for people to do that, to devote 5-10 years of their life actually working on one of these projects, you know, they need to know that the funding is going to be there, or at least sort of have a reasonable chance they're going to have support, whether it's from public or private sector. And so sometimes they're asking for a specific commitment. Sometimes they're asking for, you know, the opposite of a commitment, almost like, you know, make sure that we have the freedom to go ahead and actually do this, and there's not going to be some law in the future that's going to prevent us actually going ahead here. Or for that matter, some change in the global regulatory system that makes it more difficult to access commercial banking, lending, because there's a new Basel III sort of regulatory framework that makes banks less likely to invest. And there are all sorts of things going on in the background that, by definition, make it riskier to work on a long-term project because it takes much longer to get to the point where you get financial close. But I think the key thing for us is this is all part of the kind of the ecosystem. We've talked a lot about this in terms of capital markets. I think the same is evident in private markets. It's not stock exchanges and stockbrokers and securities regulations, but you need the equivalent of that in the private field, whether it be project sponsors, whether it be private equity funders, providers of risk capital of one sort or another, including banks, and both domestic and international banks. So I'd like to leave it there. Thank you very much to my panel here at the last minute for sort of synergizing so effectively. And thank you very much for our hosts for the whole day. Thank you very much.
Doing business in Africa. You can't afford to be without Africa Investor.